review it or share it with anyone in your neighborhood or your community. Chris mentioned I am a very proud alumna of University of the Pacific, McGeorge School of Law, class of 2000. And I have to give a shout out to my class. We're celebrating our 20-year reunion this year. And in the past 20 years since graduating, I've worked as an estate planning attorney primarily. And in the last 5 years, I've had the pleasure of managing UOP, Pacific to many of you, UOP's plan giving department. And we've worked on some really exciting gifts together with generous alumni who want to support Pacific with their estate plans. Like me, many of you have a lot of questions that have come up over the past 8 to 10 weeks with the recent world events that we're all trying to navigate, and brought up some questions that I thought would be on a lot of people's minds. For me, finance and the world markets, that's not my area of expertise, but I'm really curious about how we're going to weather these changes in this current situation. And so I asked a couple of experts to join us. They're going to be joining us in the latter half of the webinar. For the first part of the webinar, I thought it would be great to chat with a fellow alumna from McGeorge School of Law. She's class of 2007, and she also practices in estate planning. And we were able to have a really nice chat a week or two ago because she's in a different time zone. I really wanted that perspective from all across the United States because I know we have people joining us from everywhere today. So without any further ado, we will let you watch that conversation, and then I'll be joined by a recent Eberhart School of Business grad and one of our esteemed professors, and they will be here to answer some of your questions that you posted for us about the financial trends and what to expect in the months ahead of us. So enjoy some estate planning, which is essentially your plans for any type of incapacity and your plans for your loved ones after you're gone. So that's the estate planning piece, and we'll see you back here after that. Our next panelist is an alumna of McGeorge School of Law, so a fellow graduate. Her name is Katie Charleston, and she has joined us today to chat with us about what estate planning looks like in some of our other states. Katie, could you tell us a little bit about yourself and your practice?
Sure, of course. I am a graduate of McGeorge. I graduated back in 2007. Since then, I've done a variety of things, but my main focus over the past years has been both business and estate planning with an emphasis on planned giving. I am licensed in California. That's where obviously I first took the bar exam after graduating McGeorge, but I'm also licensed in Nevada, Texas, and Indiana. My practice still operates in all 4 states, but my main office is here in Carmel, Indiana, and that's where I'm coming from today to discuss this webinar with you.
Well, you certainly have a great geographical area that you practice in, so I'm really looking forward to hearing your perspective on how estate plans might differ from state to state. I think most of our viewers today are looking for more basic information, and one of the questions that I've asked and answered from a California perspective is, what generally makes up an estate plan? Does it differ for you there in Indiana versus California or Texas or Nevada?
Well, I think the most common documents in an estate plan are a will or a trust. And then you want to make sure you have your financial and healthcare power of attorneys in place. In Indiana, unlike some of the other states, what we're doing now is a Dementia Directive, which is an additional document that I'm not seeing done regularly in other states, although I have been adding it to my plans for other states. That particular document is asking people to make decisions about whether or not they want to be force-fed or force-hydrated if they're in an advanced stage of dementia. We're also looking at for a comprehensive plan to make sure if you have guardianship nominations in place, if you have minor children, and then it can be a little bit more complex depending on what your goals and objectives are, obviously. So you might have a will and a trust that leads into a successor trust to take care of your beneficiaries. We like to call them asset protection trusts that can be created in your document. But to make a comprehensive plan, you want to make sure you have those power of attorneys, a will or a trust, depending on what your objectives are, and the guardian nominations.
So you mentioned this new dementia document. Honestly, I hadn't heard of such a thing, and I'm wondering is that comparable to the Advanced Healthcare Directive that is under California law, or is it more comprehensive? And so that's on the healthcare side. And then on the finance side, is it comparable to a durable power of attorney? And maybe you could share with our viewers what that durable word means with regards to dementia and other types of those illnesses.
Yeah, so excuse me, I think I did miss one document that you mentioned, and that's the Advanced Living Directive or Living Will. It's called different things in different parts of the country. And that does cover what your wishes are if you are in a position where you can't make decisions for yourself and you're sort of in a terminal spot that would involve your representatives, or if you didn't have representatives, the hospital making decisions about, for example, pulling a ventilator. That is separate from what I'm referring to as the Dementia Directive. The Dementia Directive is an additional document. It discusses dementia directly, and it lists what stages you would get to before you would not want certain things done to you. And why we're adding this document is because we're seeing a lot of litigation, primarily here in the Midwest, around families suing healthcare and senior living facilities that are forcing people who are in advanced stage dementia, so we're talking 5 or greater, to eat. So basically they're force feeding them. And family members are seeing this as of some sort of senior abuse or elder abuse, where these senior living facilities are saying, we're just doing our job to take care of the individual because we have no document saying what their wishes would be in this particular situation, that this is our obligation. There's been a lot of litigation around this. The courts have not come out on a clear basis as to whether or not it's considered abuse. So it's sort of more of a factual situation. So by taking this Advanced Dementia Directive and having it completed and having you make those decisions before you get to us like that, you're basically letting both the facility and your family know what you would want. And it sort of prevents all of that conflict and litigation.
That's great information. And I'm really happy that our conversation went down this path, because one of the questions that I receive so often in my practice side, now I'm primarily with the university at this point, but I still advise my clients here and there. And the question is, okay, well, of the 4 documents you've named, which one is the most important to have in place? And I say, the funny thing is, it's the most inexpensive document, really, from a legal drafting perspective, that winds up being the most important. And the reason why I say is because, well, you're concerned about what's going to happen to your assets after you're gone. What's more important than how you're cared for when you're still here? And so that's usually how I explain to clients why that's so important. But of course, then go on to say, really, the components of an estate plan, they all have certain roles and they all work together in certain ways. So it's so important to have that comprehensive plan. I think that leads to another great question, and that is, how do you feel about online legal services? Well,
as far as online legal services, we're seeing during the pandemic that a lot of us can work online. So if that's, I think what you're asking though, as far as using online software to create your plan, is that what you're focusing on? Okay. Yeah. I don't advise it. I think it's something you do if it's the only way you can get it done, right? Because having something in place, a document in place that says what your wishes are as far as where your assets go, and who you would want to make decisions for you, putting that in place in any possible way is better than having nothing in place. The problem with online services is that they use template documents. And a template document is probably designed by an attorney, but it's designed for one set of circumstances. And that template just to goals and objectives, which may be different than the goals and objectives of the documents that you're getting. And it can ask you questions about the dynamics of your family and your personal situation to be able to sort of plan around it. Those documents are sort of set up in certain steps, and everyone follows the certain steps in place, and so it doesn't create a unique plan for you. I see all the time people coming to my office with a loved one's document that has failed them. And it's usually the type of document where someone's bought software at an Office Depot or Staples and done it themselves at home, or they purchased a document through an online service. So unfortunately, because those can ask you the questions that a legal professional that's sitting there with you can, I advise against it if you can actually see an attorney and have an attorney draft them for you.
That's a great response. And I think that most practitioners that specialize in your area of law would say the same thing. I mean, I know I've said it. It's the online services are really more of an emergency fill the gap because you can't get it done with an attorney. I often have heard myself say over the years, and I'm sure you have as well, is you're not paying a licensed attorney for the paper. You're paying them for their expertise and their education. And so while you may be able to get the paper someplace else, as you mentioned, you're not going to have that valuable advisor that you can ask questions and share your unique family situation. And as we know, every situation is unique. There's not a one size fits all.
Right.
So
exactly.
The next question I have is having to do with the dreaded word here in California, probate. Is probate such an ordeal in the other states that you practice in? And if not, why is that?
Okay, well, I think probate is a dirty word in any state. No matter where you are. I mean, I think in our profession, probate is a dirty word for three reasons, right? It's public, it's costly, and it's time consuming. And it can all be avoided with the right plan in place. And I haven't seen a difference in the 4 states that I'm licensed in, other than slight differences in processing time. So most states right now, at least the 4 states I'm in, the standard time frame is about 12 to 18 months to get through a probate. And the problem with that, as you know, is that it ties up assets for loved ones for that period of time, and also allows for conflict between family members from the stressors of going through probate. So I don't think that it's very different in other states. I think depending on where you live in, there are different limits, for example, as to what would exempt you from the full probate. So, for example, in Indiana, there is a small estate affidavit, which there are in the other states I'm licensed in too, where that if your complete fair market value of your estate is under a certain dollar amount, you basically get a waiver to exempt yourself from part of the probate process. And that qualifies some people, but very few people, from my perspective, do I see ever fall under the, or I guess maximum required amount before having to go to probate. So I think that probate is something that we should all avoid if possible. I do see more conflict in some states than other, but all the states, it's still a long, timely, and costly process.
I love your 3 points. I will probably steal that in the future because I talk about how costly and time consuming it is. But the other pieces, even with the small estate affidavit, you're still required to make your documents public, correct?
Right.
Okay.
Right.
So I think that's a really, another valuable point, that it doesn't get discussed as much, but that privacy aspect becomes more and more important to people to keep their information private. And like you mentioned, another point that I hadn't really thought much about, because in my practice, I learned very early on that I really, not only was probate a dirty word, but I really didn't want to have to handle probate matters. It was just not my comfort area. So I made it my whole purpose was to have a practice where my clients could avoid that, and I think most practitioners fall into that category, versus kind of older stories you hear about the family lawyer drafted the will and it cost very little. It was, virtually free. And then we learn later that that's because the practitioner's livelihood was built on going to probate.
Right.
I think, don't you feel that there's been a shift in the way that, well, I'm going to put myself in the category, you certainly fit the category, as younger attorneys, the attorneys that have been practicing in this world, that our goal is really probate avoidance these days?
I definitely think so. There are still a set of attorneys everywhere that practice the reverse of the probate avoidance, right? They're getting wills out, and unfortunately, what I'm seeing with some practitioners is they build their practice around still. I've even seen young practitioners do it, where they're more concerned with getting in a large quantity of clients at a low rate and just pushing out these wills so they can turn around and get the probate down the road. But I do see a shift for sure of attorneys going the route of probate avoidance, and which ultimately ends up in a family putting a trust in place, trust administration to keep all of the assets private but distributed under this contract that's sort of guarded by a person they name as a successor trustee.
Well, you make a good point, and it occurred to me that this is probably a conversation for another day over a glass of wine, maybe one day at a reunion, but the ethical considerations of attorneys practicing that way, not really serving your clients on what their best protection is or what their highest needs are, but more from a practitioner's preference of how they practice.
Right.
We'll leave that for another conversation.
Okay.
You mentioned a trust, and I wish I had $1 for every time someone asked me, do I need a will or do I need a trust? So I'm going to ask you that question and see, what your thoughts are there and maybe what the determining factor is on that.
Okay, sure. I look at several factors, and I do have to take into account what state I'm in when doing that, because when we're considering probate avoidance, first and foremost are the client's objectives, their goals and objectives. And so when a client comes to me, I want to know what are the reasons for putting an estate plan in place. I mean, do they just want a set of documents to pass on their assets, and they're not concerned about what happens when they're gone? Because there are a certain set of individuals out there where they don't care what happens after they're gone. Or are they looking to avoid that potential probate process and avoiding any kind of conflict, making sure that their assets are kept out of probate? And so when I'm deciding on whether or not to give my client advice as to putting a trust into place, I'm looking at the value of their estate, because one of the main things is whether or not they're going to end up in probate. And we do know that, depending on what state you are, there is that small state affidavit that might take you outside probate, at least partially. So we're looking at the total value of their assets. Depending on where you are in the country, you can estimate probate essentially is about 5 of the fair market value of your estate. So if you look at the property you own, the assets you own, and combine them, when you're looking at your house, you want to look at the fair market value of your house, take that 5% number of the total value of your assets, but you're going to end up taking off of the top of anything that's going to your beneficiaries, because that's going to go to the probate process. Looking at that number and comparing it to what a trust might cost is a good thing for you to look at, because you're seeing whether there's value in putting that trust in place. And for most people, if you own a home, especially in California, it makes sense for you to put a trust in place to make sure you are not taking those assets, those hard-earned assets, from your beneficiaries through the court process. So that's one factor, looking at these assets. A second factor is if you have minor children.
Could I ask a clarifying question?
Sure.
When you say fair market value, the question that I hear asked often is, but I have a mortgage on my house, and so the fair market value of my home in California might be $500,000, but I owe $300,000. So am I only paying those probate fees on the equity, that $200,000 difference after the mortgage is paid off?
Well, the probate court will look at the fair market value of the estate as it does, and then what it would appraise for, because they're going to be able to, the state's going to be able to sell it for that price. And so they're not taking into account equity at that point.
Okay.
Yeah. So the second thing I would look at to determine whether or not to advise my clients on getting a trust is if they have minor children. I come from a criminal background. I don't know if you know this about me, but right out of law school, I was a prosecutor for about a year in Ventura County, California. And in that process, I had experience with children being removed from their home. Now, it was a different experience. Their parents were often going to jail. But seeing children moved from their home is something you never forget, and it's something they never forget. It's a very traumatic experience. So from my perspective, I always advise parents, if they can put a trust into place, if they can afford it, that it's better to do that and safeguard not only the assets, but make sure that there's a trustee to have some continuity of the assets and the care for the children long term.
Great. Those are both really excellent guideposts, and I think easy for people to follow. So I appreciate your thoughtful answer there. I realize, you know, we've been in conversation for about 20 or 30 minutes, and I wanted to give you an opportunity to share answers to any questions that you think we haven't covered that you find are common in your practice.
Oh, I often have people ask about holographic wills, and these are wills that are fully handwritten by the testator, so by the person whose will it is, and if they can just write these themselves. And it really depends on state law. Here in Indiana, holographic wills are invalid. They are valid, as you know, in California. They're also valid in Texas and Nevada, but again, that's tricky. While that might be an alternative to seeing a legal professional, it still leaves holes in your estate plan, right? If you don't have someone with the experience to sort of guide you to make sure everything's covered. But again, it's better than not having anything if it's all that you can do in the moment. One thing that I've had come up, and specifically in the last several months, is how we could complete estate plans while social distancing. Because as you know, many states require witnesses to certain documents within your estate plan and notarizations. Here in Indiana, what we have had a short-term court order that allows remote witnessing and remote digital signatures. It has been a little bit all over the place though. So I am still advising my clients to meet me if they can. And the way that we're doing that is having drive-up signings. So my clients drive up to the front of my building. We come out with sanitized pens and clipboards, and we're able to get everything signed relatively quickly and effectively. But there are states like Texas that regularly allow for remote notaries. So depending on the documents, some of them can be notarized online, but the wills still need to be executed in person and witnessed in person. So it really depends on your state rules as to what you can do. Like I said, in Indiana, we've had this court order, but the order laid out that we were required to use specific software in doing the remote witnessing that had to be approved by the state, and the state didn't approve the software until just last week, and now there's required training before that can take place. So it's sort of been a bumpy road here in Indiana. So if those folks in Indiana can still execute in person, that's the way I suggest to do it at this point.
Well, thank you for mentioning the current conditions that we're all living under, because I think that right now that's really at the top of everyone's mind. And that was what got me thinking about, you know, online estate planning services, online will making services, not really wanting to endorse them before this happened, but understanding that under the circumstances, if that's someone's only option, that it, like you said, it's better than nothing. And then the signing challenges that we're all under with social distancing. So it sounds like you've found a great way to handle it in your office, and I'm sure your clients are very appreciative, especially when we know that so many times an estate plan is done by someone when they're older and that they might be in a high risk category. So,
right.
So those measures are very helpful. If there's nothing else that you can think of that would be a good topic to share, I think that I'll just thank you for your time. It's been great to see your face. It's nice to see people's faces and not just be on the phone. So, and I really appreciate your support of our university and our beloved law school.
No, thank you. Yes, you're welcome. I did want to just mention the nomination of guardians. I mentioned it briefly as one of the documents I'd make sure you had in your plan. For parents with minor children, I would say that's probably the most important document that they put in place to make sure they name those guardians so that children don't end up in some sort of social system or foster care if something should happen to their parents.
That's a great point and a wonderful one to end on, because during this time, taking care of our family is probably everyone's top priority.
Right, right.
Well, thanks, Katie. Wishing you well, and I look forward.
Thank you. Same to you.
At a McGeorge function in the future.
Okay, sounds great.
Take care.
Take care.
Well, I hope that everybody learned something new during that interesting conversation that I was able to have with Katie. I have to admit, I learned something new about the dementia directives. I didn't realize that there were documents that were speaking directly to that issue that so many people are facing later in their lives. And I've since executed one myself. So see, we all learn something new every day. There were also some great questions that came in during that chat. I tried to answer as many as I could live. And if there are more, please feel free to continue adding them to the question and answer section or the chat section. I also want to let everyone know that they could email me any questions after the webinar at my Pacific email address, and that's jbeck, that's J-B-E-C-K, at pacific.edu. Be happy to answer questions for you or get you information or connect you with one of our great attorneys in our referral network. Without further ado, I want to make sure we have plenty of time to chat with our panelists. We have two fantastic panelists with us, and I'm really excited to have them here. Our first panelist is a recent 2020 grad. I know he didn't anticipate graduating the way that he did, but he made it. His name is Mandeep Chopra, and he is such a sharp guy. I had a chance to chat with him. I'm really excited to have him on. If you wouldn't mind unmuting yourself and turning on your video. We're also joined by Professor Ben Carlston. He is one of our esteemed professors at Eberhart School of Business. Hi, Ben. And if you wouldn't mind unmuting yourself, and you've got your video going with your beautiful Golden Gate Bridge in the background. That's awesome. The really cool thing,
There we go.
Mandeep and Ben they know each other really well. They've worked together on some cool projects. So if you both, Ben, if you'd introduce yourself, and then Mandeep, if you'd let us know a little bit about yourself, we'd love to hear a bit more.
All right. Well, thank you for having us. We're excited to be here. So I'm, Professor Ben Carlston. I've been here at Pacific since the fall of 2013, so about 7 years. And I'm a professor of finance, and I've been the advisor for the Student Investment Fund for about the past 6 years. And it's been a really great experience. It's kept me up to date, but mostly I've just been impressed by the students that we've had and the amazing job that they've done managing, a portion of the university's money. They've done a great job over the past, 10 years they've been running it.
Well, I know, Mandeep, you were involved in that. So could you tell us a little bit about your experience? And I know everyone tunes in to see our students. They don't tune in to see me. So if you could just tell us, like what your plan is, where you're going, a little bit more about yourself.
Sure. Yeah. Hi. Yeah. Thank you for having me. So my name is Mandeep Chopra. I am a recent 2020 graduate with a double Bachelor's of Science in Applied Economics and Business Administration, where I concentrated in economics and finance. And like Professor Carlson and Joan Ellis said, I was part of the Student Investment Fund. I served as the COO of the fund this past semester. And I'm currently working as a tax preparer at a tax firm, getting my enrolled agent's license, essentially. Before starting work at the Clorox company in August as a financial analyst. But yeah, my experience with the fund has been amazing. The ability to manage real life money, completely just all students. When it says student investment fund, I think student is the key word to really be emphasized, because all decisions are truly made from us with elaborate discussions and communication and teamwork, and it's just a thrill to get to work with some sharp minds in the business school. And at the end of the day, we pay back dividends to the university. I think to date we've paid back $1 million back to the university so far. So it's great to learn and also give back to the university as well as we can.
Well, I'm so impressed. I mean, I've been here for 5 years, and throughout that 5 years, I've heard only great things about that fund. It's really impressive. And I would imagine that experience, being able to manage actual money, was that a game changer for you when you went to look for a job post-graduation?
Yeah, it really was. So I initially came to University of the Pacific as part of the Legal Scholars Program. So I've attended law classes at George, was on track to become a lawyer, and had kind of a little bit of a change of heart. And the Student Investment Fund was something I really wasn't aware of until my junior year, and had the opportunity to be a part of the fund. And that completely opened my eyes to a brand new venture in life, which I'm currently, will be doing the future for the rest of my life. So that was, I think, a key turning point, not only in my undergraduate career, but my personal life as well. Just the ability and exposure to have the fund the way it's structured really gave me a real life application. I got a degree in applied economics, so the applied part is what I really focus on. And this is finance in practice. It's not theory, it's not quizzes, exams. I had the honor and privilege of taking Professor Carlson's investment class this past spring, which is a very, very tough class. A lot of crazy calculus and proofs and stats, but how to apply that to real life money, completely different ball game. And that's what the Student Investment Fund really gave me the opportunity to have.
Well, I think hopefully by now all of our viewers completely understand why I asked the two of you to be here today. I had such a lovely chat with Katie, and such relevant information, but our economic markets can change daily. And I thought, I cannot risk having a pre-recorded conversation with the two of you and then going live and having something crazy happen. So I haven't looked today. I'm gonna let Professor Carlston talk about that. But I thought, better have you guys on here live in case something wild is going on. I wanted you to be able to speak to that. But my first question, Professor, that I had, I hope other people have wondered the same thing, is really like, without having a world crisis, what is an average historical trend in the market in terms of like a strong market, and any, is that cyclical generally?
Okay, so if you average it out, I believe you should expect about a 6 to 8% return annually, but you will see a lot of periods where, you know, it goes down or it goes back up. But that's why typically financial advisors tell you to, you know, just put your money in the market, kind of leave it alone for a while. It is risky, and that's why the return is higher than bonds, because there is the chance that it will go down. But as long as you're continually putting money into the market, you'll be buying automatically when it goes down and when it goes up. So you'll be buying cheap if it were to drop, which helps you recuperate your losses. And you'll just maintain that steady inflow into your accounts, which then, again, you should expect to grow about 6 to 8% a year.
So with the current situation that we're in, I thought back immediately to the Great Recession of 2008. I'm sure that's been on a lot of people's minds. Do you have, well, hopefully maybe you have some good news for us in what your expertise tells you about this situation, but could you give us some comparisons and hopefully maybe some differences in terms of what you think the forecast would be? Either one of you, I mean, would love to hear from both of you.
All right, I'll
Sure,
speak to it. Oh, do you want to go first, Mandeep?
Yeah, I guess I'll take some
Okay.
time here, but yeah, so I guess in regards to comparison, this is something we have to discuss a lot in the student investment fund. And one of our fellow analysts in a research session with the Bloomberg terminal found this interesting kind of comparison showing how well markets have recovered in the midst of varying pandemics, so SARS, Ebola, what have you, in the history of the stock market. And on average, within 6 months, there was only one time in history where there's been a negative return in the stock market. So at least in the short term, 6 months, history tells us that this is not going to hurt the stock market or going to hurt returns. So I don't think it'll be like the Great Recession. Unfortunately, I was, 10 years old when the Great Recession happened. So not much knowledge from back then. So Professor Carlson can probably touch on that. But at least from what the historical trends are saying, typically during a health pandemic like this isn't a typical business cycle event that is causing a recession, right? This is an external factor coming in, a natural occurrence. And usually the financial markets respond strongly to that. It'll be contingent on when the economy opens up. I think that's going to be the biggest driving force, is when is production going to be put back on? Our unemployment figures, how are they going to look? But I think this is a little bit of a different scenario, a unique scenario. I don't think it's unlike anything we've seen prior.
Agree. What are your thoughts, Professor?
So just to throw out a few differences. So in the last recession of 2007 to 2009, you saw the market drop about 56% at the maximum from peak to bottom, and that took 73 weeks to achieve. Whereas this last recession, it dropped, I think it was 32% in 5 weeks. So it was much more accelerated and rapid. And I think that's just because of how quickly the mandated shutdowns occurred. And since that's so unknown, investors didn't know how to take that and what that meant going forward. And they just pulled their money out of the market. So there was a lot of selling pressure and a lot of downturn. The recovery from the last recession, so how long it took to get back to its levels, was about 212 weeks. So quite a long time, almost 4 years to get back. And this recovery, it's already gotten returned about 50%. So half of the drop has recovered already. And so it's been kind of a quick rebound so far. But we haven't seen the markets really pick up too much. There's been a lot of volatility recently because I think there's still uncertainty in terms of how quickly will we reopen, and when we do reopen, both as a country and as a global economy, how many of kind of the small businesses are going to be around, what's the impact on the smaller and medium-sized companies, And so that's why we see the large companies doing very well, right? Like the Microsoft, Amazon, those companies are outperforming right now because everyone knows they'll be around, they'll do well. There's a need for those companies going forward. And so there's a lot of certainty, and that's why investors are flocking to those, which is driving those prices up. But hopefully we'll see over the next few months that there's also kind of a rebound in how small cap stocks do, so the smaller firms, and how the mid cap stocks do. I think recently, this past week, the small caps have started to outperform. And so that's a good sign that maybe the recovery is starting to trickle down to even those smaller businesses, smaller companies, and will hopefully be kind of a widespread recovery once we get back open.
So I have a question here from one of our viewers. He asks, is the recovery going to be a V or a U shape? And is the market currently dislocated from the reality of anticipated corporate reporting in the second quarter? That doesn't really mean much to me. So
do you want to take that, Mandeep, or do you want me to?
Yeah, I can speak on a little bit of both. So
Okay.
So far the recovery is looking more like the V shape. So I think the prior recoveries have been a little bit more U shaped. The pace of this recovery is looking pretty rapid. And in terms of like the recent earnings with the quarter two for a lot of companies, I think what you're seeing is what Professor Carlson has been kind of flocking towards, which is when the earnings have come out, the companies that have been outperforming their earnings, those are the companies that are going to get all the attention, all the price action, all the flows being placed toward them. And so earnings have played a pretty big factor in the last week or so in what stocks have been individually performing, because as a whole, the market is pretty stagnant this week. So I do think the reality with earnings is pretty consistent. But again, we don't know because the data currently is fudged with all of this delay of just systems and process and logistics. But that's my take on that recovery.
So I don't think it's going to be quite the sharp V that everyone wants, just because the opening and will go a little bit slower than everyone anticipates. And so I think that's going to, even if businesses are open, I still think it will take a little bit longer for for consumers to actually start spending their money. Just like we enjoyed hoarding toilet paper, I think a lot of us are hoarding our savings as well, unless they're on items that we really think are essential, just because we are so worried and nervous. And so I think it will take a little bit of time to coax us out, get the money out of our wallets and start spending and get the economy flowing again. I don't think it will take quite as long as the last recovery. I think it will be a little bit faster. And in terms of corporate earnings, I think everyone expects those numbers to be terrible. And so like TJ Maxx had terrible numbers, but their revenue was a little bit better than expected. And so you saw their stock kind of recover a little bit after their earnings announcement. So I think that as long as companies aren't doing worse than the expectation, and the expectations right now are pretty bad, most investors are looking forward to third quarter and fourth quarter and aren't as concerned about the numbers that are coming in right now.
So this could be a good follow-up question to that. There's a couple questions in here, so I'm trying to sift through them for you. One of our viewers asks, how would you put in perspective and explain the rate that the stock market recovered since March relative to the impact on Main Street, which I think you sort of just touched on that a little bit. Is there anything you could add to that in terms of maybe timeline for people to get more comfortable using their savings, versus hanging on to their money, and maybe whether or not you think that the stimulus package helped with the spending?
So I think that this has been a very interesting period in that some sectors and some areas and some individuals have been much more impacted by the shutdowns than others. And so we see larger corporations like Amazon, Microsoft have large cash reserves. have the ability to more easily have their employees work from home and continue their normal business operations. They're doing quite well, but the Main Street small business, mom and pop shops that have been forced to close are really suffering right now. And the hope for some of those stimulus bills was that it would help them with their liquidity issues so they wouldn't have to file bankruptcy and they can keep their employees and you know, hopefully keep open once everything does reopen. And I think we're now getting to kind of a critical period where a lot of those, even with that aid, whether they were able to get it or not, have reached the point where they need to start reopening. Otherwise, they just aren't going to have the money that they need going forward. So I think one of the sectors that will be really impacted by this is kind of office REITs and retail REITs. So the real estate of those areas, because one, I'm assuming the tenants aren't maybe paying rent, or maybe they've reached agreements where they don't have to pay rent as fully. A lot of the larger companies are saying their employees can now permanently work from home. And so demand for office space in some of those typically hot areas like San Francisco and New York, that might be dropping as well. So I think if you've typically been an investor that's investing just broadly in the S&P 500 and the market as a whole, this might be a good opportunity to start looking at possibly targeting certain sectors, because I will think that we'll see notable outperformance from some areas relative to others.
So another question, and I think this is obviously a prediction, but because of the issues that you've identified where the stimulus package may have kept those mom and pop smaller businesses going, but now it could be running out, and if the opening doesn't, you know, keep pace with their needs, do you anticipate another drop coming that would be comparable to what happened in March, or do you see a sharp sort of result, or do you think that it'll be a slower kind of a slower drop?
Do you want to take that, Mandeep?
Yeah, well, at least in addressing the question as to the bottom that happened in March, I don't think we'll see levels below than that. And I guess the technical analysis that our financial analysts have been doing, that same bottom that we had as a result of the coronavirus that's very similar levels to the market correction we had in the end of 2018. They bottomed out at roughly the same level. And so just with supply and demand, there exists like a natural force that just keeps the market at a certain bottom, and that bottom has been repeated twice. And so I can say with good probability that I don't think we'll see that bottom be breached. I think it'll be a upward trajectory. I don't think it'll be a bear market. It'll be a slow market, definitely, with all these regulations and hurdles and uncertainties with, you know, PPP funding and the SBA loans. We don't know the ramifications of those until Q3. So it'll definitely be a slow rebound, but I don't think we'll be falling below those March levels.
Okay. This is a good one, and particularly interesting to me because, as I said at the beginning, I do plan giving for the university, and we structure life income gifts, and we work with people who want to make an investment in the university, but they also need a stream of income. So this question is, how will fixed income do with interest rates so low? And do you think the proverbial 60-40 allocation is still relevant? I know you both know what that means, but maybe you could elaborate on that for our viewers that aren't as savvy as this person that asked the question.
So the 60-40 breakdown just means that roughly 60% of your retirement account would be in stocks, and then 40% would be in bonds. And that way, the thought process is you're more diversified. So if the stock market goes down, you still have almost half of your portfolio in bonds that hopefully won't drop in value as much and should kind of shelter you.
Can you elaborate on that? Because I know there have to be people out there that are wondering, you know, they hear bonds, they hear stock market, but what are the significant differences between those two?
Okay. Do you want to take that, Mandeep?
I don't know. You can keep going with it. I'll
Okay.
add in at the end. Yeah.
I just want to
far,
make sure I
Jesse,
give you an
good.
opportunity.
No,
I'm so
totally
used to
good.
having the students be the center of attention that I always want to refer to them when answering questions. So a stock and the stock market would be kind of investing in the perceived fortune of the companies themselves. And so there's a lot more opportunity to do very well. And there's also a lot of opportunity to lose very quickly. And those markets can change fairly quickly. You see some new news come in and people get really excited and the stock goes up by quite a bit. You see new news come in and it's not good and everyone pulls out of the stock market or of that company, and then the company doesn't fare so well. So even though we expect about an 8% return on the market as a whole, that comes with a lot of volatility. So you'll see some years where it's a 20% drop or it's a 30% increase, and it's just that it averages to 8%. Bonds, depending on where you go with bonds, but typically in retirement accounts, they're going to skew more towards government bonds. So these are going to be bonds issued by the US Treasury. And those are, very safe. No one's really worried about whether or not the US government's going to be able to pay you back. And so if you buy it and hold it, you know that you'll get whatever the current yield or return is for the life of that bond, right? There's no guessing about, oh, it might go up, it might go down. That will be different if you plan on buying or selling the bond, because as interest rates move, the actual market value of the bond will change. And so if you were to sell it, you could actually get a higher return or a lower return, depending on whether rates have gone up or down. So I just heard today that I think over the past month, the 30-year Treasury has actually gone up about 20% in price, even though the yield on that is much lower, right? So if you just bought it and held it, you'd be making about 2%, 3%. But if you were to buy it last month and sell it this month, you could have made about 20%. So there's some safety to bonds because they do pay that interest rate, and it's a fixed interest rate typically, and so you know what you're going to be getting. It's a little bit different with retirement accounts because those are typically bond ETFs and mutual funds. And so sometimes those prices are reflective of the market prices, and you can see changes that are a little bit larger than you might expect. And so you can actually lose money on those bond ETFs because the prices of those bonds have gone down as interest rates have gone down, as interest rates have gone up.
Gotcha. Well, we have just a couple more minutes left, so I'm looking at some of the great questions that are still left here. And I think I'm gonna make a choice here and ask you about going back to the Main Street mom and pop companies, do you think that they will be absorbed by the bigger companies? And if so, and if not, how will that affect the job market? Do you see that impact coming in our future?
So I might liken this to how mom and pops were threatened first by kind of those big box stores, right? The Barnes and Nobles came in, and then the local bookstores kind of faced some downward pressure. And they got squeezed a little bit by online retail as well and had to adapt. I think if they're able to stay open and if they have the cash to be able to pay the rents and reopen once things are going, what we've found is some of them will get absorbed in terms of, rather than going to the small mom and pop tool store, I go to Home Depot or Lowe's. And I think there's a lot of convenience there, and that's already built in. And so if these mom and pop shops have been able to weather those two trends, I think as long as they're able to reopen, there's a strong desire of their customers to support them, to keep them going. I'm more concerned about kind of the smaller restaurants and whether those will be able to reopen. But typically, I think it might be that the owner would just have to open a second restaurant or a second opportunity in that. So hopefully we won't see too much of a downturn as a result of that.
Well, I could spend another half hour talking to the both of you, but I know that we are now about 1 minute over, and I just wanted to give you both an opportunity to say anything in closing that you might want a chance to add, and to say thank you to both of you, as well as Katie, who I see is one of our viewers today, for joining us to cover both of these really relevant topics. So any closing remarks from either of you?
I'll just say thank you guys for tuning in. Definitely crazy times, both in the financial markets and in normal life. And just take a deep breath, enjoy the time. I would say just have a good rest of your week, and thank you for the opportunity.
Great finishing words. So true. We've got a long weekend coming, and wishing both of you the best and your families the best.
And then could I say one thing also?
Yeah, please.
Before we wrap up. I think in times like this, it's always important to remember that, you know, you have an investment plan, a retirement plan, and you need to stick with that. The past several years have kind of said, oh, the market always goes up. That's what it's supposed to do. It just goes up, and then I can check my account. It'll be green. I'll be excited, and I'll know that everything's going to be okay. But there is volatility. It does drop. You know, we saw at the end of 2018, there was a drop. This is another drop. But we need to remember that this is likely not a collapse. And so we just got to stick with our plan, be patient, and know that this will be there and we'll have security going forward as long as we've been thoughtful about it. It's, you need to be careful about making decisions with your emotions in times like these. And I think that's why research has shown that average, typical individual investor, so like you and me, we underperform the market because in the downturn, we wait because we don't want to sell after we've lost 20%. So we wait a little bit longer, and then we're like, okay, I can't do this anymore, and I sell and realize that loss. And then when the recovery happens, we say, oh wait, this isn't a real recovery. I'm not going to put my money back in yet. I'm going to hold on to it because I'm scared from last time when I sold. And then we end up buying when the price is high. So just naturally, our emotions are going to cause us to sell low and buy high, which puts us at about a 2% worse than the market on average. So rather than earning 6 to 8%, we're earning about 4 to 6% when we're letting our emotions take control of our investing decisions. So whether or not you feel comfortable with managing your retirement yourself, or whether you want to have a professional to kind of talk you off the cliff and realize that it's okay, I think it's important to know that, yes, I have a plan. I'm going to stick with that plan. Things are a little crazy right now, but I'm just going to, you know, maintain my automatic deposits into my retirement account, trust that my plan is secure. And if I want to do a little adjustments, I can make some small tweaks, but we really want to avoid the panic sell-off or panic buy in times like this. And I think we'll see some of the stocks that have done very well, like the healthcare stocks that everyone is excited about in terms of their treatments and the trials. Some of that might be a little bit of a bubble, and we'll see those fall back to earth as people realize that maybe these aren't going to be very profitable. So it's just keep cool, keep calm, invest on, don't pull out, and just know that your plan is ready, and it'll keep you prepared and supported in the future.
Well, thank you. Those are really comforting and inspiring words to end on. I think that it's excellent advice. And I know, just like I made the offer for anyone looking for an estate planning attorney, we have some fantastic financial advisors that are part of our alumni association and part of alumni base. Be happy to be a conduit to connect you, anyone out there that needs an advisor. So thank you to all of our panelists. Thank you to our Pacific Alumni Association that joined us, and thank you to our facilitators and our viewers. Have a great day.
Bye, thank you.
Bye.